Don't you wait for the perfect interest rate. They might never come.
Literally, this is not just a daily conversation.
And that's why I'm bringing it up today.
Oof, loaded question.
What exactly the interest rates are?
Interest rates is definitely something everybody asks about.
It's pretty confusing. It's not very straightforward.
It's completely insane. What you don't know has the ability to hurt you and hurt you badly financially.
Simple, maybe little numbers, what they can gain or lose.
Every 1% drop in interest rate helps another 5.5 million people qualify to buy a home.
Is there such a thing as the best credit score?
Abso-freaking-lutely.
What would be your suggestion to normal average buyer?
Oof, I don't know. Don't laugh.
Hi everyone, welcome to my channel. My name is Galina Shekhtman. I'm trusted advisor in San Diego for over 25 years. Interest rates and what nobody explains you clearly. Today, we're gonna talk about very important topic, interest rates, how they affect you, and much more into that. Today, I am joined by experienced lender Ella Gurfinkel, and I would like to introduce her to you.
Thank you, Galina. As you've mentioned, experienced, past my 30-year mark in this sometimes insane industry, so I don't know what it makes me at this point, other than a workaholic. But interest rates is definitely something that everybody asks about. It's almost like nobody knows what to ask other than, what do you ask a lender? Ask them about interest rates. Kill me now, please.
It's pretty confusing. It's not very straightforward. So some people just think that the interest rates that they've seen online, this is the interest rates that they get.
You've nailed it on the head. And unfortunately, this is the conversation that I literally have.
That's why I'm bringing it up today. That's why I pointed that out. So
spot on. Literally, this is not just a daily conversation. This is a conversation I had now with the same client twice this week on Zoom, showing the actual interest rate that is specific to them based on their credit score, their down payment, their type of transaction. And I keep getting pushback on the rate saying, but wait, I see, so the rate I'm quoting is 6.125%. The pushback from the client is, but wait, I am seeing this 5.75 online. Like, send me the link. Guess what? They send the link. The link shows, 5.75, but that 5.75 may cost you $10,000, but it's in a small print. So really, the bottom line is not all rates are created equal. And what most clients don't understand, what most buyers don't understand, is that just because you see a rate online, it doesn't mean that rate belongs to you or that rate will not cost you. So when I say the rate doesn't belong to you, that simply means that every client's interest rate is determined literally on individual set of parameters. And that's where it gets so interesting, because when people say that, well, my friend just got their loan closed, or my friend just locked their rate in at blah, blah, my question back to them is going to be, bring me your friend's paperwork. Do you know their credit score? Do you know how much they paid for the rate? Oh, you don't. So let's talk about the actual rate and how and where they happen from.
So what exactly the interest rates are and why? Partially answered why they change so often.
The first thing that anybody needs to understand is that the interest rates, first of all, change daily, sometimes multiple times per day. And where do those daily rate changes come from, or what are the rates based on? Again, most people think that the rates are based on the US Treasuries. Most people think that the rates may be tied to the Fed rate, the prime rate that everybody hears about. The Fed rate just got lowered or Fed rate went up. Those are not related to the mortgage rates, and the mortgage rates are not tied to them. There is a very loose and indirect relationship, but directly, The rates on the daily basis are derived from the daily trading. So just like the stock market, daily trading of the U.S. mortgage bond securities, whether it's a 30-year mortgage bond, whether it's a 25, 20, 15, 10, that's basically what drives the interest rate for that specific loan length. Now, there is usually a profit margin, obviously, between what the bonds trade at and what the lenders will charge. They have to make money. And the mortgage bonds also trade by different coupons, and that's where we're getting way into the weeds. So not diving that deep in, but the bottom line is that the mortgage bonds, based on their movements, will affect the daily interest rates. And it's not something that you can necessarily actually track online, because unlike the stock market trades or the stock market movements or the NASDAQ movements, you can't typically get live access to the mortgage bond trades. Notwithstanding, the mortgage bonds, again, are at the basis of interest rates to start with, and that's the main point. Now, understanding that base, there is more to it. Every single mortgage program is based on a different subset of mortgage bonds and potential adds or loan level price adjustments. So the pricing, as in the interest rate for an FHA loan, will be based on the Ginnie Mae traded bonds versus the conventional loans based on the trades of the U.S. mortgage bond securities. So FHA, VA, USDA, that we lovingly, sarcastically refer to as govies, those are all tied to Ginnie Mae, basically government-issued bonds, whereas conventionals, again, go back to US MBS. Now, the pricing, depending on the program, will vary significantly by purpose of transaction. Purchases and refis get different pricing because the LLPAs, the loan level price adjustments, vary for each purpose. On top of that, if you're buying owner-occupied, second home, or a rental, you're looking at different rates, again, because of the LLPAs. It gets darker from there. Your credit score and your down payment, as a combination, also drive the interest rate. So if you're comparing side by side somebody with a 620 credit score or a 720, there's going to be about a 0.5% difference in the rate potentially. And that's on conventionals. This differential may be a little less on FHA, USDA, or VA. And that's, again, without even going into any other loan product type. So the bottom line is that everybody's situation is different. Therefore, I'm going to get a different rate on my owner-occupied purchase than, for example, Galina is going to get if she's trying to buy an investment property. Or somebody who's buying a rental, they're going to get a yet different rate. So the bottom line is that depending on your personal situation, your rate will be different from mine or Galina's. Depends on whether you're buying a home to live in, owner-occupied, or you're buying a second home, or maybe you're buying a rental. Are you buying a single-family home, a duplex, a triplex, or a fourplex? Are you putting 5% down, 3% down, 10% down, 20, 25% down? Those two make a difference. So as a result, what we have to do on the lending side, we have to price every single transaction based on its factors, based on its components, as opposed to the rates are the same for everybody.
So now let's talk about the purchase price. Should we wait for the interest rates to drop, or should we purchase now with whatever the rates are as of today? What would be your suggestion to clients? For example, let's just say normal average buyer with good credit score and 20% down. Saying Galina, today's whatever, 6.125. I just want to wait a little bit longer, maybe a month or 2 or 3, maybe could be the feds are talking about it, the rate's gonna come down. So give me a few scenarios with the mortgage. For example, median price in San Diego, it's about $850. Let's just say $1 million. Buying it today with 20% down versus, for example, 5% more. Not the interest rate, but the purchase price. 3 months down the road.
Oof, loaded question. There's a lot to unpack there.
I know. Make it kind of like simple, maybe little numbers, what they can gain or lose, or is it going to be equalized?
So my typical advice on waiting versus for the lower rates potentially, which may or may not happen. Of course, we hope and we expect.
We hear it.
Yes, we hearing. Rumor mill is great. Yes, there is a wide expectation that the rates will come down some in the next year and a half. So we're kind of sort of expecting maybe to hit 5.5. Don't quote me on it. However,
and again,
the
it's
general
like
expectation,
literally almost like looking at the crystal ball. We wish, we want, we think.
We're willing it into existence.
We're putting it out there in the universe. Then the God is our witness. We cannot promise anything, and it's not up to us, and nobody can promise you anything for sure.
So as far as waiting, let me throw a little statistic at you. And the stat is as follows. Every 1% drop in interest rate helps another 5.5 million people qualify to buy a home. Does it mean that all 5.5 million will hit the market all at the same time? No. But even if a fraction of those people hit the market,
it's still a big pool of buyers.
It's a huge additional pool of buyers. So guess what? We already have a shortage of homes. And even though we are kind of sort of trading on the seller's market in parts of the country, shortage of homes plus a major crap ton of additional buyers, and you're looking at multiple offers again. Supply, demand. Right? Supply here, demand goes up, the price will go up. So you're looking at potentially losing money by not buying today when you can, and when you can negotiate seller pay closing costs, repairs, inspections, etc.
You're in the better position to negotiate. That's
exactly.
For sure.
As opposed to when there's multiple offers, when you can't negotiate and you can't ask for seller concessions. Repairs, or whatever other additional little benefits you can garner. Not only that, you're also looking at higher prices. So the little advantage you gain by a slightly lower rate will get outweighed by a much higher housing price, because not only the higher housing price results in a higher loan amount, it also affects how much money you have for down payment. Because you may have 10% down.
It's a domino effect.
It is a domino effect,
yeah,
yes.
It affects everything else.
So potentially, you're looking at actually shooting yourself in the foot. Because I'm not going to use the beat up, date the rate, marry the house.
Yeah.
Not the point. The point is that you can buy today on better terms, meaning the house itself. And when the rates actually do drop, then you can actually refinance and lower your rent by already being in the house and already having seen your house
equity.
Appreciate. Exactly.
We're talking the same language, different two words.
We've been the same forever and a day. So really, if it's a choice of waiting or buying today, I'm not saying it because I'm in the profession. I'm saying it from a financial and monetary standpoint that's beneficial to you. I don't stand to win necessarily from somebody buying.
We are here not engage you in mortgage or purchasing a house. We are here to
educate you.
Explain and educate. So you will be prepared, and when you're ready, bingo, you will be fully ready. So yes, I want to buy it today. I'm ready. This is my family. This is going to be my house. It's going to cost me today this amount of money. Tomorrow it could cost me more. You'll be in charge of your decisions.
Exactly. And to be honest, I know you asked me about like $800K, $1 million, situation price-wise. I would estimate just off the top of my head.
We just, guesstimate briefly. We are not here to calculate the pennies.
Right.
We want to give the full picture, what you can gain or lose.
So I'm going to use a slightly different example, and that's the numbers that I was actually running for a client yesterday. A 0.25% difference on a $500K roughly loan was roughly $40 a month. Yes, I understand that $40 every month accumulates over
still
time.
money.
I get it. It's still money. I'm not being cavalier, nor am I being judgmental. But in the big scheme of things, you tend to lose a lot more than the $40 a month by waiting. So if we double the 500, okay, so roughly that's $100 a month. Again, I'm not being cavalier. I'm not being judgmental, but $100 a month on $1 million purchase, it's probably not the last $100 a month that you're
Yeah.
willing to spend. And that's where the rubber meets the road, because the home going up will result actually
Much more
in a lot worse
than
scenario.
$40 a month.
Yep.
Okay. Ella, what is the rate lock? And when is the good time, or when is the right time to lock the rate for the purchase?
Great question. Amazing question, actually. And I appreciate you asking it, because that's also where a lot of people don't quite understand. As I work on somebody's pre-approval and we talk about the rates, once again, I mentioned that in the beginning, so rewind, please. The rates change daily. And that's one huge piece that people don't understand. And that's why I appreciate this question so much more, is that because I got you pre-approved today at a rate of, let's say, 6%, if you're finally buying a house 2 months from now and the rate is at that point 6.25%, that pretty much is going to be your rate. Because the earliest point you can lock the rate in is when you have entered into a contract and that contract has been received by your lender. Until then, the rate is the rate on the market. It doesn't really pertain to you. A rate lock is something that guarantees you the rate for your loan based on your credit, based on your purchase type, loan type, down payment, and potentially a few other factors like how many units in the property or type of a property even. So again, the first day that you can lock the rate is when your lender receives your executed, accepted contract. Now, whether you should look at that time is a conversation to be had between you and your lender. Because if the market is in a position, and again, there's technical, stochastic indicators, yada, yada, yada. If the financial market, as in the bond market, is in a position where the rates are improving day by day and the technicals indicate that we're on the improvement path, meaning the rates are getting lower, then my advice to clients for the last couple of weeks has been, let's hold off on locking. Because technically, we can lock the rate in till about 10 days before closing. So do not lock up front, because your rate is going to be better, meaning it's going to be lower, or the cost of the rate may be lower as the time goes by. Now, if you have no tolerance for stress, anxiety, risk, you can always ask your loan officer to lock the rate in at the day of receipt of contract. And then your rate is guaranteed. And the typical locks are usually 15 days, 30 days, 45 days, 60, 90, and so on. Now, let me know this, that the longer the length of the lock, meaning how much time do you have to close the loan, essentially, or per contract, will also drive the cost of your rate up. The 15 days are the cheapest. The 30 is the most typical. There is not much of a difference between 15 and 30, by the way. But once you start going past 30, that's when the cost of your rate starts increasing. So that is something to be mindful about when trying to do a longer lock period. Now, again, should you not? You are the judge of your risk tolerance. You are the judge of the professional level of your lender. So hopefully you have enough trust in your lender's market knowledge and understanding that they can give you qualified advice, whether it's worth it to lock now or whether it's worth it to wait. Now, complete side note, a lot of lenders nowadays, including us at Fairway, have an option to do what's called upfront lock, forward lock, lock, shop, and go. Different lenders call it different names. In effect, that is something where, yes, we can lock your rate in at your pre-approval. That rate lock is good for 90 days. But, as I just mentioned, because it's a 90-day lock, guess what happens? Your rate automatically is higher.
And log calls it's locked.
Yep.
You
And your
cannot
rate
change
is
it.
locked. The upside and the downside to locking the rate is that if the rates go up, you're protecting. That's the upside. The downside, the rates go down, you're done. You're locked. That's it. The rate is fixed in for you. You can't really change it. We can't change it as lenders. So again, as far as the forward locks go, 2 years ago, 3 years ago, when the rates started getting on an up curve faster than we could blink, forward locks were an amazing situation. But there's a finite number of days, and you have to build in the 30 days to close into that. So you only have like 2 months to find a house and get it under contract. And that is also something to be accounted for stress-wise, risk-wise, etc. So as far as forward locks go, you be the judge. Not a fan personally, especially in the times like now when the rates are actually on the downswing as opposed to the upswing.
I just got a question. Galina, what credit score gives the best rate? Is there such a thing as the best credit score?
Yes and hell yes, as a matter of fact. So the feds, in their ultimate wisdom, sarcasm, rolled out the new LLPAs, loan level price adjustments, just about 2-3 years, well, actually about 4 years ago now, where previously, if your credit score was 740 or better, you were golden. And now you have to have a 780 for the premier or top tier rates. The way the credit scores affect the interest rates, again, when it comes to conventional loans, mostly that's where you see the biggest impact by dropping by 20-point intervals. Credit scores, 20 points, 780, 760, 740, 720, 700, 680, and on down. Not only does your rate increase via the loan level price adjustments, but if you're putting less than 20% down, your mortgage insurance also gets more expensive at the lower credit scores on the conventional side. The govies, again, FHA, VA, USDA, those are not as ugly in terms of changes to your rate at lower credit scores. Those are a lot more generous and a lot more forgiving. But there still is a little bit of a difference between a 580 and a 600. About quarter point. 6 to 620, 640, 660, 680. And usually with the govies, once you get over 680, the difference is pretty minuscule, regardless of down payment or lack thereof. But again, on conventionals, unfortunately, what the feds did, and when I say feds, I mean the FHFA a few years ago under the prior administration, they have effectively raised the loan level price adjustments and by extension the interest rates for the higher credit scores and higher down payments. I know it sounds illogical. Higher credit score, higher down payment, you're actually paying more in the rate than somebody with a lower credit score and lower down payment.
It's a little tricky.
It's not confusing.
It is confusing.
It is. It's completely insane. That also will affect the interest rates, but the nutshell is the higher the score, the better. But the old adage about the 740, unfortunately, is no longer necessarily true. There are actually programs that will not even allow the credit scores below 720. So those are specialty programs, of course. Yep. So if you do need to know more about getting your credit scores improved, little plug, I've got plenty on my channel where I talk about the credit scores and getting them better. And that's Ella Mortgage Lender. So come check it out.
That's perfect tips. I mean, a lot of people probably needing that.
A lot of people do.
At least to check it out and which position are they at?
What you don't know, unfortunately, in this situation, has the ability to hurt you and hurt you badly financially.
Yeah. I just got another one. Is adjustable rate mortgage is a good idea or not? I do have an answer. I want you to answer and then I'll give my input a little.
This is a question that I can't really be completely impartial on because I have my own thoughts, my own
Yeah, that's what I want. I want your personal
my own
thoughts.
inklings.
Yes.
So let me actually say this first. The adjustable rates today are not your adjustable rates before the crash. And a lot of people attribute a lot of negative connotation, a lot of negative feelings, and a lot of rejection to the adjustable rates because of how much damage they caused back in 2007 through probably 2015, to be honest. I don't feel as badly or as negatively about the adjustables. They're a great financial tool if you're good at managing your money. Because an adjustable loan, it's not something that starts adjusting immediately nowadays. Okay, there's been a lot of reform, there's been a lot of change. So the adjustable rate loans now come in a form of hybrid adjustable or fixed adjustable type of product, where you get 3, 5, 7, 10, in some instances 15-year fixed rate, and then it starts adjusting afterwards. 3, I don't really talk about those a lot, nor do I offer them. And frankly, personally, that's where I think they don't make any sense. It's too short of a period of time. However, if you know you're not going to be in the house for more than 5 years, at least let us take a look at the 5-year rates, because it may make a hell of a lot of difference. As an example, yesterday, FHA rates, at least the FHA rates I was quoting to clients, were 5.75 for a 30-year fixed versus 5.25 or below for a 5-year FHA fixed adjustable, meaning 0.5% difference just by taking the 5-year option versus the 30.
It's a
In
lot of money.
some people's lives, it makes a lot of money. So how long are you going to be in the house? How is your financial situation going to improve in the next 5 years? Does your credit need work? Are you looking at a higher income potential down the pike? If you are,
Exactly.
if your house in the area that appreciates fast, then my opinion is it is worth taking the 5, because your financial situation will improve in a year, 2, 3, for 5, as an example. The home will appreciate, your credit will improve. I can help you with
refi
that.
at the better rates and have less mortgage payments.
Exactly.
So that is going to be towards your advantage.
Exactly. So govies, unfortunately, only offer a 5-year fixed option. Now, again, to the pushback about the adjustable. On the govies, they're the most, not to say that the adjustables aren't regulated, but the govies are the most restrictive when it comes to the lender side. So a 5-year, for 5 years, you get a fixed rate. After 5 years, your rate will only adjust once a year on the nose, on the anniversary date, by no more than 1%. But that 1% can actually go up or down. So if the basis that the rate is tied to, the index, goes down, so will your rate. Personally, I had that happen to me with our very first townhome when my adjustable rate, yes, I took it for myself, when the adjustable rate actually went down, so I maintained the same level of payment as I had at the higher rate, and every month now the money went towards the principal. So it was a win-win for me. But again, not everybody can do that, obviously. So there is a place and a time for adjustables. On the conventional side or non-traditional loan side, there are 5, 7, 10-year loans, the 5 years fixed period, the 7-year fixed period, the 10-year fixed period. After that, most of those arms, unfortunately, adjust every 6 months. And then it varies upon lender and upon a program how much that adjustment can be capped at. So all adjustables have caps. First adjustment cap, and lifetime cap. And most of the lifetime caps are set at 5% over the start rate. So if you're getting a 5% interest rate adjustable today, regardless of term, when it starts adjusting, or whenever it adjusts, rather, the lifetime cap on that rate is going to be 5 plus 5, so you can never go over 10. I know it sounds like a lot, but the chances of that happening are honestly about zip to zero. So I don't feel bad about adjustables, but they're not for everybody. And you know your tolerance better than I do. I can offer it. I can lay out all the positives. I can lay out all the downsides, but ultimately you decide.
You're the one who's going to choose.
You're the one making the payment.
You. One more question. Buy down the rates.
Oof.
You don't have to go deep into it. just briefly, because some people do not understand what does it mean.
There are multiple types of buy downs, right? And we're
Yes.
probably, what you're asking me is
Is
actually
it worth
buying points,
exactly? Yeah, buy down the
buying points
quarter
to
points, half a
lower the
point,
interest
to lower
rates.
the interest rate for a certain period of time. Some people don't understand. They think that
Certain
they're
period
buying
of time or for
down.
life.
Yeah, exactly. Yes.
So what we're talking about is a permanent rate buy down or the so-called discount points. And I think this is where there's so much misunderstanding in the market. It's probably
Yes.
the biggest misunderstood piece of mortgages that you can ever imagine. So first of all, can you get a lower rate than today's market rate? So earlier in the video, we talked about the 6 and an 8% interest rate, 6.125. Can you go lower? Yes, you can, but it will cost you. That's what we refer to as the discount points. It's not a discount on the rate, meaning
It's buying down the point.
it's buying, it's
not,
paying to get a lower
and
rate.
you're the one who's paying those points.
And the points, just so that we translate it to the normal English out of the mortgagees, 1 point equals to 1% of your loan amount, not your price, your loan amount. So if you're borrowing $500,000, that is your loan amount. 1.1% is equal to $5,000. 2 points is $10,000. And I can keep going. Usually we don't really deal in even numbers, unfortunately. They're
Right.
always goofy and there is a decimal and something like 3 digits past the decimal. But the more you pay in discount points, meaning the more you pay, translated to dollars, the lower you can get your interest rate. Do you want to pay $20,000, $30,000 to get your rate into the fours? You are? Great. Do it.
If you
Not really, but
have
being
that
sarcastic.
amount, if it's an FHA loan was 3.5% down, obviously you don't have, the money to finance your you don't have the money to buy down your
You're right.
points.
So the biggest trick in the book, unfortunately, and this is what, to be honest, abso-freaking-lutely drives me batshit crazy, boils my blood, makes steam come out of my ears, and you kind of get the picture, is when you're looking online and you see that the rate is 5.5.
And you jump on it.
And you jump on it. Well,
You
first
say,
of all,
well,
if
my
it's,
lender didn't tell me that.
if it looks too good to be true, it usually is. Thing one. Thing two, that rate usually comes with hefty discount points. Surprise. Meaning, if today's market rate, and by the way, you can always Google, and that's exactly what I did talking to my client yesterday. What is today's conventional mortgage rate with insert X down payment? The interwebs, and Google's my best friend, came back with a range of 6.1 to 6.5. So we were actually on the lower side of the range. Now, if you're seeing something outside of that range, your heckles should be up. That is not the rate that you are paying the absolute minimum for or not paying. If the rates are outside that range, it means there must be a much higher cost attached to get that rate. Now, the conversation I take all of my buyers through during the pre-approval process, and then once again, when we are in contract, is I show them the rate, I show them the market rate, I show them the lower rates, and I show them the cost of that lower rates. And then I take them through the calculation of what is the difference in the monthly payment between all of those incremental rates versus the cost of the rate. So if it's going to cost you $10,000 to go from 6 and an eighth down to 5.75, but your difference in the payment is only $100, you do the math. You divide
How many
$10,000
will it take?
by $100 a month. How long will it take you in months and then years, obviously, to recoup that upfront cost over that minuscule monthly savings? And is it worth it?
Exactly. And we coming back, how many years you're going to stay in that house or at
Exactly.
that property?
So if we roll back to that 10 grand over $100 a month, that's 100 month.
Yeah.
That's over 8 years.
And again, you're the one who's choosing it all.
Right. You're in the driver's seat. If you have the money to pay, great. Does it make sense is a whole other conversation.
Exactly.
I take the emotion out of the whole rate and money conversation. I deal in numbers. This is the one time where I'm not going to get emotional. This is the one time where I'm going to tell you point blank that, in my humble opinion, not so humble, thou shall not.
But it's clear opinion. It's, as I always say, you can't beat math and numbers.
Right.
That's the
Math is
raw,
math.
that's the data that you need to see for yourself. And again, choose for yourself.
This is frankly a lot of times where math is not mathing. Comparing the rates online. My other favorite, speaking of which, is when you look at your local banks and it shows today's 30-year rate for blah, blah, blah is blah, blah, blah. But wait, what you need to do, not just look at the rate, not at the top line. You actually have to scroll down the page, find the disclaimer,
See what else
where it actually says 99% of the time when you're looking at bank and credit union rates online, yes, they're in open access. It will say the rate above with an asterisk implies 25% down, not 20, 25% down, X credit score, and X purchase price. Meaning if you have a lower loan amount, your rate can be higher because there's sometimes ads for that. If you don't have that credit score, your rate may be different. If you don't have 25% down, that rate is going to be different. So when you actually go to the bank, they can't quote your rate without pulling your credit. Speaking of which, this is another piece that when somebody calls me and asks me, what is your rate today?
My rate today, I don't have any rates for today, personally.
I don't know. Don't laugh. That is the honest to God answer. I don't know what my rate today is. It can be a 5 or it can be a 12. Are we talking about an equity line? Are we talking about second mortgage? Are we talking about what are we talking about, first and foremost? Secondly, if somebody's quoting your rate without actually looking at your credit report, run. Absolutely run. As fast as you can, run like a wind, because just because you give somebody the credit scores that you looked up on Credit Karma or Bank app or whatever the hell.
It's not the same.
It is not the credit scores that we look at on the mortgage side. There are different credit scoring models, and that's a whole other conversation that I've done multiple videos about. But we have to look at your credit scores on a given day, and that credit report is good for 120 days, okay? So if somebody's quoting your rates without knowing what your mortgage credit score is, without knowing what your situation is, that is not the rate that you will end up getting, because the rate they're quoting you is absolute BS. And that's honest to God truth.
So we covered what the interest rates are, when is the best time to lock, should I buy down the rate, what else did we cover? Should I wait to buy now, or should I wait till the interest rate's going to go down? We covered
a lot of ground.
A lot.
Obviously, there's a lot more where that came from. And we're never going to be able to cover everything.
It's like an opening another can of worms. I mean, you cannot put in one video 100 and 1,000 of hours of work done with multiple clients because of their different situation and case scenarios.
Right. Just remember, when somebody's talking about their interest rate, that theirs is better than yours, it's kind of like mine is bigger, you know? Realistically, until you see their paperwork and you can show it to me to prove, I'm not going to believe any of it. As a matter of fact, this is probably going to make you laugh. And I don't know if I ever told you the story, but I had a client probably about 20 years ago who bought down the rate against my advice because they already told their friends and family that that was the rate they were getting.
Oh, that's a good thing to do. Mm-hmm.
Anyway, you be the judge of that. Nobody needs to know what your rate is. And no, comparing your rate to your friends, family, neighbors, coworkers, whatever, you can't. It's like comparing your health profile to somebody else's. Everybody got their individual quirks. And same comes to interest rates because they're so individually driven. And that's really the main point, is that It's not a one size fits all. It's not what is your rate today question. It's what is the best rate for you? Because one of the biggest mistakes I've seen clients make over the years is the lowest rate is not always the best rate
And then
for
might
your
hurt
situation.
you. It might hurt you.
Absolutely. It's not always. There are instances where you need to take a higher rate for a number of reasons. So talking to the financial professional and actually listening to their advice is probably the main thing that you can do. And if you don't trust your financial professional enough to listen to their advice, well, that's a whole other conversation.
Find another one that you really trust and will take an advice from.
Absolutely. And sometimes even Google is wrong. Or ChatGPT for that matter. But again, that's a whole other conversation.
And that's, again, nobody's perfect. Google not always perfect. ChatGPT is not always a perfect. All of that are the tools.
Yep.
But they cannot define your exact situation.
Precisely.
Don't you wait for the perfect interest rate. They might never come. Find the perfect house. Look for the strategy. Find the perfect team. And Ella and I would love to work with you if you will choose us. We'll work with all our heart in your favor.
I couldn't have said it better. And don't be that guy that's looking at everybody and comparing notes. Ask the professional, trust the professionals, and find the professionals, even more importantly, that you can trust. We'll see you on the next one. And if you have any questions, ask away. We'll answer your comments.
With our hearts.